but let me introduce you Venk Shukla from Thai Angels, and we're going to have a conversation with Venk about how Thai Angels is going about looking at the entrepreneurship ecosystem and so on and so forth. So let's dive in. Venk, tell us about Thai Angels and how do you work with investors and with entrepreneurs?
So, Thai Angels is about a 7-year-old organization, and it's really a collection of individual investors, you see, who in general tend to focus on B2B kind of companies, and the whole idea is that the collective wisdom of the group, helps make better decisions, improves the deal flow, and as well as collectively they are better able to help the entrepreneurs. But I will tell you that that I have I'm also a VC now. I have a seed stage fund called Monta Vista Capital. So,
okay.
So bulk of my time is spent on Monta Vista Capital, but I do participate in Thai Angels still.
Okay, and how big a fund is Monta Vista Capital?
So the first fund was $10 million, and the second fund is in the middle of raising is $30 million, and the first close is already done, and I already started investing from my second fund also. The first fund made about 20 investments, and about 18 of them were on B2B also.
So your focus, as well as Thai Angels' focus and Monta Vista Capital, all of it is in the B2B software segment.
In general, that's the accurate statement to make. The only exception is where in those consumer areas where a deep technology IP is the differentiator and the driver.
Okay.
That's the only exception. Otherwise, B2B is the default.
Can you talk a bit about stage? What is the comfort zone for you and for the Thai Angel community, for the Monta Vista Capital investments? What do you look for in what you're willing to consider as an investment?
In general, Thai Angels and Monta Vista Capital, I think we are a seed stage investor, which is before the VCs have come in. And in general, we look for at least a team, and we look for a big idea, but also we look for validation of that idea. Validation does not have to be revenue. Validation does not have to be a product developed and everything, but validation is that if you think that this is your product vision, have you talked to people in that domain? Have you talked to potential customers in the domain? And what do the potential customers say about the problem you're trying to solve, and the urgency of solving it, and their willingness to pay for solving that problem, and how much are they willing to pay for that problem? So I think it's not just a raw idea, but the experience and expertise of the team, as well as the validation of that idea in some form.
So when you say you're looking for a big idea, talk to us a little bit about how you are, where in the B2B software segments are you seeing these big ideas, and maybe a few examples of the kinds of things that either you've invested in through Thai Angels or through the first Monta Vista Capital fund.
So
just to give us a flavor.
So here's an example, right? Let's say in big data, there are a lot of companies that seek to solve the problem if there is a lot of unstructured data. There are also traditional companies like Teradata and products like Exadata from Oracle that solve the problem if you have only structured data. The reality is that today you have a mix of unstructured and structured data and in huge quantities. And there is no solution to that because all the Hadoop-based solutions really don't have a good sense of structured data and how to handle that. So that's a big problem to solve. And it's not, solution of this problem, requires a fundamental understanding of not just the relational algebra, which is behind databases, but also a very good understanding of how to handle unstructured data. So that's a big problem to solve. Another big problem to solve, for instance, would be, how do you, there are a lot of chat bots right now to automate customer support, but all the big enterprises, these chat bots, very soon would need to pull out information from their SAPs, from their Oracles, from their Salesforces and stuff. So not a technology in isolation, but a technology that knows how to work with all these back-end software. So, so innovation, innovation by itself is okay, but innovation, with the eye on solving a particular problem is better, and it's potentially a big problem to solve. Another example, would be, in cybersecurity, all the existing products that exist, they're all rule-based, which means they throw up a huge number of, and rule-based ones are basically based on prior experience and expertise of the team. But the cyber attackers have become so sophisticated that you need solutions that that can evolve, and grow and think for themselves, which means artificial intelligence, which machine learning. So how do you apply machine learning as a replacement or as an enhancement or rule-based solutions that exist to prevent data theft? So these are,
some trends.
The interesting thing is that what has happened is that because of cloud, the data center, the problems that used to exist in data center, they're all migrating to the cloud. So all those problems need to be solved again. Plus, it's generating a new set of problems. So there is no. So I don't think that all these problems have been solved. There are a lot of new problems to solve in that sense.
So I'll provide a bit of commentary for the audience on some of the things that you mentioned as trends. So the unstructured data problem, we've actually seen this unstructured data problem also being solved for, almost a couple of decades. There have been companies, major companies that have been formulated on this unstructured data problem. Autonomy was one of them that went very big, actually, on that problem. But today, one of the trends that we are seeing is that this whole unstructured data problem being solved for specific verticals or specific functional areas, and solutions built on top of solving that unstructured data problem in a cloud-based architecture with AI, and those can be very interesting, very compelling new companies to pursue. On the cybersecurity side, there's a lot of AI applications in the cybersecurity side. Cybersecurity, however, is an extremely over-invested segment. It has always been so. If you look at the last 20 years of the venture capital industry, cybersecurity may be one of the most heavily invested areas in the industry. So if you are doing a company in cybersecurity and you're looking for angel investors, seed investors, and eventually VCs, you would need to position your product very, very sharply so that you can differentiate and clearly articulate where exactly you play in that heavily, heavily crowded market. So those are just kind of like a couple of comments based on the trends that we have just discussed. Venk, I'm going to ask you to comment on a few broader trends that I have identified, and I'm, getting inputs from lots of investors on these trends. So let me get your input here as well. One of my observations is that we are in 2017. Lots of stuff has already been built, but there are many, many niche opportunities around what has already been built. Some of these businesses need to be built for very small amounts of capital, $1 to $2 million, and sold for 10 to 15 million. Is there appetite in your community for this type of investment? And what about a lot smaller, like invest 250K to 500K and sell for 5 to 10 million?
I think that's a very attractive proposition. When I started out, as an angel investor in 2010, 2011, that was my guiding principle, that I would look for those kind of opportunities. What I gravitated towards was, again, going for big ideas, and the reason for that was simple. What I discovered was that startups are inherently risky, and unless you are going into an area where the barrier to entry is so high that you just don't see more than a company or two in that area. It's very hard, to figure out where to bet on, because startups are inherently risky and they fall apart, for non-business reasons. Sometimes the founders don't get along with each other. Sometimes there's a lawsuit. Sometimes, for a whole variety of reasons. So as an investor, as a professional investor, you soon realize that that risk is not any smaller investing in a niche market, because the whole lot of other risks that exist with any startup apply to those startups as well. The only exception here would be something like, let's say, semiconductor intellectual property, where there are only 5 or 6 experts in the world who really understand that area, and 2 of them are working with this great professor who has dedicated his life to understanding that area, and they start intellectual semiconductor IP company. You can be pretty sure that it's not going to be a crowded space, and you could be pretty sure that if they do the job well, the company will have an exit for $20 to $40 million. But other than those kind of those niche areas, anything else, there's a risk that it could become a feature of a bigger platform or a bigger play, and then unless your timing is right and you're targeting the potential acquirers very well, you could just miss the opportunity.
Right. So this is actually a very good point that I'm seeing in the people who are, there are angels who are angels and incubators, accelerators who are following this strategy of going after these, smaller opportunities, niche opportunities, where you're right, you need to find an expert who's a real expert in that specific domain, and then the cycle kind of needs to be closed with the acquirers. So these kinds of opportunities are best tackled when you have a good close relationship. As an investor, you have a good close relationship also with the corporates who are going to become the eventual acquirers. So you're almost like, validating it with the acquirers, building it up to a certain point, validating the opportunity, and then, selling into that acquirer who has almost given you a thumbs up front that, yes, go and build this and we'll acquire you.
Yeah. No, I think that's I think this game can be played, but it requires a really, really deep domain, not just deep domain expertise, but deep domain relationships.
Yes.
So that, if I'm doing this marketing automation, this niche in marketing automation, here are the 3 potential acquirers, and and they need to know what specifically I'm doing, and so that I could have a quick exit. Because if I don't have a quick exit, then you see all these assumptions. All this, you have to raise more money, and if you raise more money, then the valuations, and if the valuations, then the expectations of exits are higher, and on and on and on. The problem compounds itself very, very quickly.
Yeah. So you can play this at with a very specific domain focus, with a specific set of corporates around you, and in some cases, actually, these corporates are investing in these little micro funds that play this game. So it is a little, side of the industry that is developing because, we are in 2017. There are these little niches which are not venture scale niches. They're not going to be venture fundable. So if you can only play these if you work with little bits of, seed money and then pretty much go straight to acquisition and not go out to raise a venture round.
Yeah, absolutely. But as critical as understanding of the niche and the technical chops to develop it is the relationship in that target ecosystem. I mean, are you familiar? Are you aware, or do you have anybody in your team?
Totally agree.
That has that visibility and relationship with the key players in the industry.
Yeah. Next question, another trend. How do you process the current investment climate where capital is moving further and further upstream? How does an angel group or an entrepreneur for that matter mitigate the Series A gap? Funds are becoming bigger, and the venture funds, venture funds becoming larger means that they can only do larger Series A's. So, and there is a group of investors that are playing into that gap and doing the 2 million, 3 million Series A's, but the more traditional firms are going to 5 million, 7 million Series A's, and they want, they already want a 1 million ARR, in the case of a cloud investment before they're going to put in any money. But getting to 1 million ARR, as you know, as a seed stage investor, takes time and takes quite a bit of navigation. And sometimes that is a gap where people are falling into. So they get a very, very beginning investment, and then they're not quite ready for Series A, so they need more money in that gap stage. How are you dealing with that in your funds or in your Thai Angels investments, and how are your entrepreneurs dealing with that?
It's a very good question. I think, I have one situation where, and that really is in the crowded cybersecurity space, where there have been some failures in that space, or failures in the sense that that people have raised a huge amounts of money, but they haven't really delivered corresponding returns. So VCs have become worried. That's one situation I'm aware of where this Series A gap is a problem. But in all the other companies that I'm seeing, if you're really solving, a potentially big problem, and you're solving it, in a way that inspires confidence, I'm not seeing that problem. I'm seeing that problem, only where it's a struggle, to differentiate the company and what it does in a very fundamental way. But if you're doing something which is highly differentiated and potentially a big market, I'm not seeing any problems with getting Series A funding, whether it's 3 million or 10 million. There are plenty of choices available, as you said, because NEAs of the world and Secures of the world want to invest 5 to 10 million. There are plenty of these $100 million funds that have come up, in last 2-3 years. To pick up that slack, and they are pretty active. But
yes, I think the best thing that has happened for the Series A gap actually is this, in the last 3-4 years are the $75 to $100 million funds that are willing to do the 2 million, 3 million Series A's, because that was clearly a requirement in that category.
Yeah. You're absolutely right. I mean, I think to give you a perspective, see, on my fund, this thing, I have about 12 major investments, and about 7 of them is raised venture funding, and none of them had any difficulty. 3 of them are not raising any VC money because they're doing well. Only one of them is having a problem, and it's having a problem because they happen to be in a very, very crowded cybersecurity space where a crisp differentiation from the pack is a challenge.
It's very hard, yes, very, very hard. So of your ventures, the ones that have raised venture money, have they raised venture money from these $75 to $100 million kinds of funds, or have they raised money from the bigger funds?
They are typically raised from bigger funds because these are big spaces. Like one of them I talked about was, how do you handle structured and unstructured data together? And that's a very, very big problem to solve. Every company in the world has that problem, and there is no solution. So that's one. With the onset of only predominantly mobile access, the old networking problems have not gone away, but the new ones have piled on top of that. With cloud applications, mobile devices, access points, and the bandwidth thing. So how do you quickly, using machine learning, how do you quickly isolate a problem when somebody complains of poor responsiveness? And so that's a new category, a big problem. The third one is how do you create a virtual private cloud in minutes? So that the traditional route of DevOps and testing and deployment, those are 3-4 months long processes. How do you cut that short and do it in minutes when something has to be rolled out very, very quickly in a very secure way? Something like using artificial intelligence to prevent data theft.
Okay. So these are the kinds of problems that for lack of better words, are where the unicorns are supposed to come from.
Yes, absolutely. I think you hit the nail on the head. So my learning has been that in theory, what you said about if you're a small investor, then the strategy is to find a niche, a defensible niche, and entrepreneurs who can exploit that niche and get an exit. And if you can, in practice, what I found was that those combinations are very hard to find, except in industries like semiconductor, intellectual property. In any other space, whatever niche that you start out with could easily become a feature of something bigger, or if it's not executed very, very quickly, then there are plenty of others who show up. And then if you can't get a quick exit, then all those problems multiply.
Yeah, I think I completely agree with you. You can play that game only with relationships into the acquirers. Otherwise, you can't play that game.
You can't play that game because if it's taking longer and then you have to raise money, then you're back to the same equation again. Except you are working in a small niche where in the best case scenario, you
can't raise money.
Yeah.
Small niches don't have time to raise venture capital at a significant level.
Exactly.
So, but getting back to the unicorn opportunities, those are also few and far between. It's not like unicorn opportunities grow on trees. And that has a different set of issues that are happening right now. Because there's so much money in the hands of the larger funds, and there's so much private equity and late-stage funds, and the epitome of that is SoftBank's $100 billion plus Vision Fund. there is unicorn mania right now. So if there is a company that has the characteristics of, being able to become a unicorn, that those companies get smothered with funding. And as a seed investor or as an angel group, you could get buried under later stage liquidation preferences. How do you protect it?
Yeah, no, I think it's a good point. This problem presents itself, if the opportunity is attractive, then the investors, are careful, and the company has a lot of negotiating leverage. So I'll give you one example. This big data company that I was talking about, with no customers, no product, no revenue, they got a valuation of VCs put in $20 million at a valuation of $100 million, and this is potentially because they think it's a unicorn kind of a company. So this thing we're not stringent at all, because they want to get into the company. They cannot afford this to dictate their terms.
Well, there are a bunch of problems coming about later on. So this is to get into the company, and then as you go further down, there are funds like, there's a bunch of Middle Eastern money coming in and wanting to get into attractive deals like this, and they are buying out they're giving the founders a lot of liquidity as one of the ways of getting into the deal. That's creating another set of issues also. If you look at
that's very unhealthy.
Uber, for instance.
Yeah, that's very unhealthy. A really, really unhealthy kind of a trend.
Very unhealthy trend.
I'm seeing that, that happened, in India, 2-3 years ago. And all these entrepreneurs who haven't returned a single penny to the investors, they're buying, $5-6 million homes and, becoming active angel investors and stuff. And the companies, haven't done diddly squat so far.
Yeah, and this is a part of the problem of having too much money in the system.
Yeah, no, I entirely agree with you. But this too much money problem is really a later stage problem. At the early stage, at the seed stage, if you're not talking about ICOs for blockchain based thing, then it's not really a problem. And I think this overabundance of capital is for companies that are startups that are reasonably successful and raising the Series B, Series C types.
That's right.
But at the seed stage, I don't see that problem.
No, there is actually a pre-seed problem. There were like 70,000 companies that received angel financing or some sort of a seed, pre-seed financing, very early stage financing, in the last few years, these numbers of like the companies that are getting these very early stage financing has been very high. But the number of companies that actually get venture financing remains at 1,200 or so. So there is, in the middle, where there is, companies that have crossed over to being credible companies, that set of companies is actually much lower. And a lot of companies that get funding are getting funding from, again, for lack of better words, dumb investors who don't know what they're doing, and they're just writing checks and creating a glut in the funnel in the early stages as well. But it is not. It's in the middle where you have good companies. People don't have access to the deal flow into those good companies. And so on and so forth. It's a kind of a cumbersome early stage that is developing because of the entrance of a whole lot of very impractical and unrealistic set of expectations on behalf of people who have made money in the last few years. So there's, smart money is rare, smart deals are rare, but there is a glut in the dumb money and dumb deals.
Yeah. I think that's there's one thing that that has happened recently is that the cost of starting a company has come down so much that there are thousands of experiments taking place, and actually, which is good for good for everyone, because more of these ideas you see get tested, you see, and explored, you see, and validated, and only some of them you see make it to seed funding, and then you see to VC funding. So for the VCs, I think the risk, this thing has gone down significantly, because by the time a company gets to them, a product market fit has already been established.
Yeah.
And, so
there is a lot more bootstrapping these days, which is a very healthy trend, because that's how you take out the product market fit risk, and the more you take that risk out before going to investors, the higher your probability of getting funded anyway as an entrepreneur.
Yeah, I haven't seen the data, but my hunch is that the number of companies getting Series A funding is not any lower than what it used to be. It might even have gone up.
No, it's been constant for the last decade, about in that 1,200 or so level.
Yeah,
it hasn't changed very much.
Yeah, but what has happened is what you just said, the bottom of the pyramid, there are far more experimentation going on.
Exactly.
And which is good for the ecosystem, good for the economy. Except those who don't get funded, you see, subsequently it's good for everybody else.
Yeah. So last question, Venk. We're a bit over time-wise. What kinds of companies would you like to see? Give us some guidance on, like, what's your fantasy deal? What segment, or where do you think you would like to make further investments right now?
So the areas that that really excite me are ones you see where you're applying technology to solving some domain problem, let's say insurance industry or telecom industry or something, where you have some unique oil and gas industry, where you have some unique insight, where you have deep understanding of the industry, and you're using technology to solve that problem. So that's one category of problems that I look at. I'm interested in those companies that are solving those. The second category is if it's a general purpose kind of across a lot of verticals kind of a platform kind of a technology, then you see what I'm looking for is some fundamental transformational technology, and that really comes down very heavily on the expertise and the quality and the track record of the founders.
Yeah.
Or the third one, I'll tell you. One company I invested in, one of the rare consumer companies I invested in, they make women's bras using there's some tricks up the sleeve in terms of fit of the bra, as well as the supply chain and all inventory and all those things. And that has been a surprising success I see in my portfolio. They will do something like, in the third year of their existence, they will do about $100 million in revenue this year.
Wow.
And so that's it's a unique insight, because the founders knew this problem that 30% of the women cannot find a bra their size, and they have to go to the store and try a number of different ones before they find it. So this is a company driven by that insight.
Yeah.
So I think something like that which is solving one particular industry's problem, driven by unique insight. I think even if the technology is not transformational. So that's one category, and the second category is where you're solving. Let's say you have the next generation application performance management solution. You have the next generation network analysis solution, something like this. Next generation database kind of problem. Those are the things that I'm looking for.
And when you do cybersecurity, you need to really be very precise in terms of positioning of how you differentiate in this very, very crowded universe.
that's so it's not just from venture funding standpoint. What I'm discovering is that in cybersecurity, every big company is dealing with at least 20 vendors, and they absolutely don't want to deal with 21st vendor.
Yeah.
So that's why having something which is very crisply kind of identified its end position becomes very, very important just to get traction in the market.
Yeah. Venk, there's a question from the audience. We'll take that question and then close off the session. How many ideas do you review in, say, a month when you're looking for companies to invest in?
Typically I review about anywhere from 15 to 20 ideas, and the review is in some cases a full throttle review. In some cases it's just looking at the presentations and quickly making a decision that this is not a good fit for me. But I about 15 to 20 pass through my desk every month.
Okay. Well, very good talking to you, Venk, and we'll, hopefully we'll have a chance to work together more in due course. Thank you for making it. I know you had a lot of cumbersome logistics overnight, but I'm really glad that we were able to have you over anyway. Thanks for coming.
Thank you for having me. Thank you for having me, and you're doing a good service to entrepreneurs.
Thank you.